Hello everyone, my name is Cameron May. I'm a senior manager here at Schwab, and we've all heard the phrase, fail to plan, plan to fail. And if you think there's even a chance that might apply to trading as well, then you're in exactly the right place. This 4-part mini-series is going to focus on how a trader might develop their own custom trading plan. We're going to talk about how a trader might define for themselves things like what to buy, how much to buy, when to buy, and when to sell. So let's get right into it. First thing that we'd like to do as we dive into this series called Creating and Developing a Trading Plan, I'd like to issue an invitation to you after today's presentation is over. We have other resources available outside of these series, including a presence on X. It's the best place to connect with your favorite presenters. You can find me on X at Cameron May CS, as you see right there on your screen. But let's get right into session one, and as we do, of course, we need to pause to consider the risks associated with investing. Risk is real, so please bear this important information in mind. The information provided here is for general informational purposes only. It should not be considered an individualized recommendation or personalized investment advice. Any investment decision you make in your self-directed account is solely your responsibility, and investing involves risks, including the loss of principal. All right, so a quick overview of our 4-part series. We're going to be focusing on, what a trader might look to buy, how much to buy, when to sell. So the very first discussion we're going to have is regarding 3 items in that category of what to buy and how much to buy, including an investor's trading style, their time horizon, and their position size. In other words, how much are they intending to buy, invest, and risk, right? In session 2, we'll get into the entry strategy that a trader might have as they're building out their investing plan. On the back end of that, we're going to talk about the exit plan in a trade plan. And finally, we want to work through a trade plan, see if it's actually working, assess its performance, and see if refinements might be required and made, how that might be accomplished. So getting into today's agenda, let's first of all discuss what are we trying to accomplish as we're building a trading plan. What are the objectives of a typical trade plan? Then we're going to go through the trade parameters, deciding what to buy. We're going to determine our trading style, a time horizon, and again, using that, what might be unfamiliar terminology, position size is exactly how much an investor plans to place in each trade. How much are they going to invest, and how much might they be willing to risk? And then before we're done today, we're going to build a watch list using the thinkorswim desktop trading software. So I'll show you how that might be done. That's where we get to the application of this sort of theory of building a trade plan. How might we actually execute it using the tools available on thinkorswim? All right, so what are the objectives of a trade plan? Well, what is the purpose of building a plan? Number one, as a trader is attempting to add discipline and structure to their approach to trading, they may want to make sure that their approach is repeatable. This means that each trade should very much look like the last one, and each trade should build upon the last, hopefully working more and more toward a successful approach to trading. Using an approach to trading that isn't structured and not repeatable, in my view, it's very much like, for example, let's say you're trying to get into shape and you decide to go to the gym. Well, going to the gym without a structured plan for progressing can be kind of a difficult endeavor. Showing up without a plan, just sort of picking a machine and getting in there, starting to sweat, and changing your mind, moving on to the next thing. It can be difficult to assess one's progress, to make refinements in areas where one is struggling, and to progress. So we want to make sure that our plan is repeatable. Next up, the trader's typically looking to minimize their own personal interpretation of what's happening in a trade and minimize the emotional influence. Now, if we're leaving each trade to our own interpretation on a case-by-case basis, that brings with it a lot of pressure. It can also allow fear and greed to guide one's approach. And fear and greed can lead to all sorts of trade mismanagement behaviors. For example, fear can cause us to exit winning trades early or prematurely. Greed might allow a trader to make excuses for failing trades and stick with losers for far too long. And for some traders, they have a term for that. That's called trimming the roses and watering the weeds. So minimizing interpretation and emotional influence, a typical objective of a trade plan. And then finally, the trader would probably want to make sure that their trade plan is appropriate to them and their unique approach and needs. So the trade plan should match a trader's goals, their tolerance for risk, and their own preferred trade timeframes. All right, so let's talk about getting into and creating one's own trade plan by defining, first of all, what we call our trade parameters. This is defining for oneself the sorts of stocks, for example, that one intends to trade. So step number one is to identify our own unique trade style. Now, typically, and this is very flexible, but typically traders will fall into three primary trade styles. First of all, we have what we call fundamental investors. And these are investors that emphasize measures of the company growth, relative value, or potential for income. Now, so in other words, we're looking at the comparative health, quote unquote, health of the company behind the stock. And that might be accomplished using metrics such as key growth and value ratios, such as price to earnings, return on assets, and investors might be looking for things like income potential from a stock. So dividend yield might be a point of emphasis for our fundamental traders or investors. So that's one style of trading, and it can carry a very unique approach in its own plan. Next up, we have a technical approach, which is a trader who puts more emphasis on what's happening on a chart. Now, these traders employ personal and indicator-assisted observations of movements on those price charts, such as trends and historical price patterns. So the emphasis is not so much on the company behind the stock, but the performance of the stock itself. Now, you might be wondering, well, can't we use sort of a blend of both? And actually, for some traders, they do precisely that. They will use something known as a hybrid approach or a trading style. And that's where we use a combination of fundamental and technical parameters. Okay, so it is not my position to tell you, if you're creating your own trade plan, which of these is appropriate for you. That's up to you. Just define that and begin to flesh out and build and write your own trade plan. Okay, so defining the parameters, step number two is to identify our time horizon for a typical trade. And generally, again, traders will fall into one of three categories here as well. We have single session traders, swing traders, and position traders. Single session traders are very active, and they look to gain from small price variations over very short time periods. And this might just be literally minutes to hours, and they do that throughout a single trading day. Now, these sorts of traders will most commonly be more of a technically oriented trader, not giving a lot of emphasis to the fundamentals of a company, the growth or value parameters, instead looking at what's happening on a chart. Now, swing traders are traders who take positions that typically last a few days to a few weeks, so not single session, but lasting a little bit longer than that. And they often trade from price floors to price ceilings or vice versa, and they have specific planned profit or loss price levels. Okay? Now, these sorts of traders, in for a few days to a few weeks, also very commonly will be more technically oriented. However, some will recruit that hybrid approach where, if we're going to be holding on to a position for a few weeks, for example, maybe the trader might go to the extra effort to determine as much as they can for themselves whether there is a fundamentally healthy company or strong company behind the stock that they're trading. And then finally, we have position traders. Position traders put the emphasis on the position that they are trading or investing in. They typically look for larger gains that can take months or even years to achieve, and they may not have a specific target price. So they might buy a stock without knowing precisely at which price level they're planning to sell. Instead, they might prefer to stay in the trade as long as the stock trend persists, or as long as the fundamental strengths that attracted them to that position in the first place remain intact. So as long as, let's say, their value or the growth metrics have not changed substantially. So yeah, those sorts of position traders very commonly will emphasize fundamental strength over technical strength. Now, a final step for defining our parameters is to determine our position size. And this is where it's an easy thing to do conceptually, but it's also easy to overlook. But this is really calculating the number of shares that the trader is willing to invest in or trade, and how much risk per share they're willing to take on a trade-by-trade basis. So position size specifically refers to the maximum amount the trader is willing to invest per trade, as well as the maximum they're willing to lose per trade. And those almost sound like the same thing. Well, if I buy a stock for $10, can't I lose $10? Yes, that's conceptually possible. But if we buy a stock for $10 and we have a planned exit if the value drops to, let's say, $8, well, in that case, we're investing 10, but really only conceptually risking 2. Investment and risk, very different. So let's go through a couple of example calculations for calculating investment versus risk. Let's say that we have a $100,000 account, and the trader has decided in advance that they're willing to invest 10% of that account as a maximum per trade. Now, obviously, if we're investing 10%, that will allow a trader to take at a maximum for that account up to 10 trades at a time. But 10% maximum per trade would give us a $10,000 trade limit on an individual trade. Now, setting that limit also has potential psychological benefits. Using different position sizes from one trade to the next, let's say we invest $10,000 in one stock because we feel great about it, and $2,000 in the next stock is our next trade because we don't feel quite so strong about it. How do you think that might influence the management of that trade going forward? Well, our trader may, quote unquote, fall in love with that larger position and make excuses for it if it starts to misbehave, and that might guide them toward abandoning their predetermined risk parameters, for example. Whereas with the smaller trade, maybe they just, well, there's not much risk there, so we'll just let it go, and that might lead to the smaller trades ultimately doing better, delivering lower returns though. Larger trades are abandoned quickly because of fear, for example. And yeah, that's just an example of the sorts of mismanagement behaviors that it can lead to. But yes, consistency across a range of positions might be a good habit. So if we have our $100,000 account, let's say our trader has decided to place a $10,000 trade or investment limit. And let's say further that the stock that they've settled on is $50 per share. Well, if they have $10,000 that they're setting as a maximum, at $50 per share, that would mean for that trade, we have a 200 share limit, no more, okay? Now, the loss is quite different, but the calculation fairly straightforward. Sticking with the same $100,000 portfolio, let's say the trader has decided they're willing to risk not more than 2% per trade. That's a $2,000 trade risk limit, okay? Or a trade risk limit. So if we have $2,000 that we're willing to risk, 200 shares that we can buy, well, that means that we better not be taking more than a $10 per share loss on each trade on that stock. Okay, so important limits being set seems like a simple thing, but yeah, it's a big deal to set these sorts of parameters within one's trade plan in advance to keep that structure and discipline from one trade to the next. All right, so we've mapped out what sorts of stocks, well, the style that we might take, the time frame, the position size. How about we go build a watch list of some stock trade candidates? So a watch list is a list of stocks that a trader has found that meet the sorts of things that they might be interested in as characteristics of a stock, but they're not going to buy just yet necessarily. They'll buy when their rules for entry are met, okay? But there are some potential watch list considerations, and those might fall into the categories, again, of fundamental or technical. So fundamental, as I mentioned before, is sort of the the quote unquote, the underlying health of the company behind the stock. So some of the fundamental considerations here might be the size of the company, small, mid, or large cap, growth metrics, growth ratios such as return on assets. There might be value metrics here that could be used as qualifiers for a watch list. So things like PE ratio, price to earnings. Some fundamentally oriented investors will place an emphasis on a company's potential for income in the form of dividends, or they may have specific sector requirements. Maybe they think that healthcare is doing well, and so they have a watch list of healthcare companies. Obviously, that's just an example. But those are some fundamental considerations. Now, on the flip side of that coin are our technical considerations. Among those, and this is not an exhaustive, these are not exhaustive lists. One should feel comfortable in adding one's own flavor to these lists, but among potential considerations for technical watch list characteristics, we might look for stock price. For example, our swing traders might prefer maybe small to large cap stocks that are between, in let's say not too low in price, but maybe not too high in price either. Obviously, the word TOO2 being variable from one trader to the next, but stock price might be a point of emphasis. The liquidity of the stock, the ability to get into and out of the shares efficiently, might be a strong point of emphasis for a stock to even be qualified to be added to a watch list. The inherent volatility of the stock, our position traders might prefer calmer stocks. Our single session traders might actually like stocks that move around a lot. So just being in for a few minutes to a few hours might provide more quote unquote potential. And then finally, a trader might prefer to have stocks in a watch list that are exhibiting trend strengths or weaknesses that are consistent with what they plan to do with that stock. Okay, so we're already starting to see how one can start to structure a trade plan. That's all fine. That's all theory at this point. But what I want to do now is just go to the platform and start to put this plan into practice. So let me turn my camera on here. And let's pop over here to our thinkorswim desktop platform. Now, if you don't have this, you can download this free of charge from your Schwab online account. And then you just log in using your Schwab username and password, same login credentials. But we find ourselves here on thinkorswim on the monitor tab, and I want to conduct an example scan for stocks to be added to a watch list. So let's go to our scan, and we're going to use the Stock Hacker today, which is a scan, a screen, a filter, a search tool that allows a trader to tell thinkorswim what sorts of stocks they're interested in potentially trading, and then thinkorswim will assist in finding stocks that meet those characteristics or criteria. So let's think back on those fundamental and technical potential variables, and let's start to construct our own potential watch list. All right, how about we start with, let's say that our trader is, let's say they're a swing trader and they prefer that hybrid approach. Okay, so the time frame is swing, their style is hybrid. Well, hybrid means that we use a combination of fundamental and technical variables to look. We want the stocks that exhibit both of those characteristics before we'll add them to a watch list. So let's start off with how about the size of the company? So here on the scan feature, I can scan if I wanted to direct this to a more targeted area. So for example, if I wanted to look at a specific sector, I could route this to a specific sector. I'm not going to do that today. We're going to look for any and all stocks that meet our criteria. And the criteria don't need to be terribly demanding in order to reduce the list of potential trade candidates pretty rapidly. But let's first of all say that we're looking for stocks that are of a certain size. Well, our swing trader, let's say they don't necessarily want the really tiny little stocks. Maybe they don't like maybe they have an assumption that the very low stocks are possibly just going to be too volatile, too many unknowns regarding their fundamentals, whatever their logic might be. Let's say we're looking for a market capitalization that's maybe mid to large. So we've probably heard this term before, market cap. just refers to the size of a company as defined by the price per share times the number of shares. So if we have a $100 stock that has 1 million shares that are trading, that's a 100 million market cap company. And that might sound like a big company. 100 million sounds like a lot of money. Now, on the grand scheme of things in Walmart and Wall Street, that would actually be solidly in the micro cap category. So small cap companies, typically 250 million to about 2 billion. Mid cap, 2 billion to 10 billion. Large cap, 10 billion to 200 billion. And then you have what are called the mega caps. Well, let's say that our trader is just primarily interested in maybe those mid cap to maybe the larger end of the large cap. Let's go for a minimum here for our market cap size of, I'm going to put in 2,000. What you'll notice here on our scanned criteria, it says the dollars are in millions. So 2,000 million would be a $2 billion company. That's at the lowest end of those mid-cap companies. And then how about we just, let's put this in here for a maximum, 200,000 million. That's a $200 billion company. So that'll narrow the range of potential trade candidates, 3,562 companies meeting that criteria. We're already starting to narrow the field for our watch list. Next up, how about we look at price per share? Now, a number of different ways we might define price per share. On thinkorswim, what might be commonly done is to use something called the mark. That's an abbreviation for the market price, okay? And let's say that our swing trader is looking for stocks that maybe they're not too low in price, not too quote-unquote volatile. So let's set that minimum for our example today at $20 per share with a maximum. How about we go up to $100 per share? Maybe our trader just doesn't see as much potential for the higher priced companies. Whatever their logic is, we can just build that into our scan criteria here to look for stocks that meet whatever the trader's preferred watch list metrics might be. Okay, now what about the volatility of the company? One measure of volatility is a stock's beta. Let's add as a filter here, beta. Okay? Beta is really a historical performance metric, price movement compared to the S&P 500. If our company tends to move with the S&P 500, up or down, right? Let's say it just moves as the S&P goes up 1%, our company tends to go up 1%. If it goes down 1%, the company tends to go down 1%. We would say that it has a beta value of 1, or in other words, it has a 1-to-1 relationship with the S&P 500. But that can be very commonly used as a gauge for volatility. So how about we set our minimum at 1? Because our swing traders may be looking for something with more movement in it, but maybe, let's say, quote unquote, not too much. How about we set our maximum at a beta value of 2, or in other words, twice as volatile as average is our ceiling here. Okay, so that's 3 potential stock criteria. If we were to scan with just those 3, we still have 774 companies meeting those criteria. So let's add a couple of other metrics. So going back to our list, remember that some of our traders in our hybrid approach here, there can be an emphasis on fundamentals. So let's go up here and add a new filter, and I'm going to choose a fundamental criteria, and specifically, how about we do return on assets for this example? That's basically just a gauge of how much profit a company is able to generate based on its assets, including debt, okay? And for some traders, they might see, let's say, a minimum of 5% return on assets annually as a quote-unquote good number. Now, clearly that is a number that can vary from one trader to the next. But let's just set our minimum at 5. I'm not going to establish a maximum here. This is clearly not the only fundamental criteria that might be used. It's a growth-oriented criteria. Maybe somebody has more of a value orientation, or maybe their emphasis is on dividends. Let's just leave it here for this example on growth. And finally, what about a technical indicator? Yes, we can add technical criteria here using what's called a study filter. So I'm going to choose study. And let's say our trader is just looking for stocks with pretty strong volume, okay? So let's go to our study criteria, choose the volume on the pop-up menu, and let's just go for average volume. The default is going to look at average volume over the last 50 days. And let's say we want to look at that average volume. How about at least, what should we say, 3 million shares? Let's put it on a minimum here at 3 million. Okay. So let's now run our scan, see how many results we get. Let's run a scan. All right, so we just narrowed it from 774 meeting our first 3 criteria to only 38 meeting all 5 criteria. Now, these criteria should be consistent from one trade to the next. So as a trader builds out their preferred criteria, we want to write those into a trading plan and then carry those forward. Now we can go into thinkorswim and re-enter these each time we want to run a new search or a new scan for a new list of potential candidates, or we can just come up and save that scan. Let's save this scan and let's just call it our swing trade candidates and just save that. And what that does is it saves the scan. It also saves that as a watch list. So for those of us who use watch lists, over here in the left column, for example, we can go to our watch list, go to our personal watch list, and there are our swing trade candidates. Let me open that up here. Oh, that has yet to populate, so it's still working on that. In any case, let's now place a trade. Okay, and we're going to place this according to our position size requirements to an extent. So it looks like we have Celsius Holding, we have Chipotle Mexican Grill. Let me show you how a trade might be placed on thinkorswim. So first of all, a quick calculation. Let's stick with that 10%, $10,000 on a $100,000 portfolio example. If we have 10,000 bucks that could be invested, and we divide that by CMG's last trading price of $58.19, that would tell us as a maximum we'd want to buy 171 to 172 shares. I'm going to round that just slightly. I'm going to go down to 170. We're keeping it under the maximum, not exceeding the maximum. So we're going to go to our trade tab and let's buy some shares of CMG. I'll just click on the ask price to create a buy order. And let's hide this left column for just a moment. Let's change our quantity to 170. You can see our quantity now set to 170. I'm going to enter this as a market order. We could change this to a limit order if we wanted to specify a maximum that we're willing to pay per share. But let's leave that as a market order and just click confirm and send. We're going to buy 100 shares of CMG. There's not a commission on this trade, but with market orders, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. In other words, just because it's around 58.18 at the moment doesn't mean we're going to pay exactly 58.18. Market price will fill wherever it fills. Let's click send, and we now own 170 shares of CMG. And you might be thinking, well, Cameron, hold on, pause. Was today the right day to buy CMG? And what about the risk on the trade? We know how much we've invested. How much have we risked? Well, we need to talk about when to buy and when to sell, and the influence that can have on position sizing, the influence it can have on the structure of the trade. And then, of course, we want to wrap it up with a discussion of how to hopefully refine our approach as we have more trades and we can learn from those trades, right? But yeah, we need to get back to talking about when to exit. But guys, we've actually accomplished what we set out to do today. Let's go back here to our slide deck. We've discussed the objectives of the trade plan. We've outlined trade parameters determining style, time horizon, and position size. And we've built a watch list on the thinkorswim desktop. But please do make a note to join us for session 2, which is going to be about defining one's entry strategy. Yeah, we just bought CMG. Sure, it met our criteria from our scan, but for some traders, they prefer to try to refine the entry of their time, and they try to optimize that. Well, how might that be done? How might that be written into a plan? Next time, we're going to be talking about that entry strategy. So we've accomplished what we set out to do for this webcast, for this video. I do have other recommendations between now and watching the next video, unless you just move right on to the next one, which is fabulous. But there are resources outside of these videos. Number one is that you can access or connect with your favorite presenters on X. So for example, you can find me on X at Cameron May CS. And it's the best place to see what I'm thinking in between the live streams and between these sorts of video series. But also, it's the best place just to connect with me. If you reply to one of my posts, I just try to reply right back to you. Now, the other suggestion I have for you is to subscribe to our Trader Talks channel on YouTube. This is the very best place to find our playlists of other webcasts that are organized into series and topics. So whatever one has an interest in learning, you can go to the playlist there. You can also join our live streams here. So make sure that you're subscribing to our YouTube channel, Trader Talks, Schwab Coaching Webcasts. Following and subscribing doesn't cost anything. So we'd love to have you as a follower or subscriber. All right, so everyone, thanks again for joining me for this webcast. I will see you in session 2, exit strategy, as soon as you want to launch that. But I do want to say again, thank you for giving me your time, and I will see you in the next one. Bye-bye.